MAET returned negative 12.2% in the March quarter. The fund's long positions and currencies were the key detractors to performance, while shorts and put option hedging were relatively flat as we recycled any hedging gains into additional risk management positions to help minimise volatility as the quarter progressed. The first quarter of 2022 has been difficult for global financial markets. What began as a growth equity correction escalated through February with the Russian invasion of Ukraine and concluded in March with a vicious bond market sell-off on the back of an increasingly hawkish Federal Reserve. From a stock attribution perspective, positive contributors came from our more recent names in Food Revolution, Nutrien and Deere & Co, as the issues in Eastern Europe have highlighted the need for greater food security and the importance of farm management to improve efficiency. Longer term, they're expected to benefit from resource scarcity and the shift to sustainable agriculture. The main detractors were high-performance compute names Advanced Micro Devices and ASML. This is not the first time the fund has experienced a 10% drawdown, and it won't be the last. Having been here before, it is important to draw on experiences formed over the last 15 years of managing international equities, and we will now share the guideposts we look at to help plot the path ahead. We remain confident in the ability of our portfolio investments to grow earnings through this uncertainty and ultimately deliver returns to our clients. Looking ahead, this is a highly uncertain time. When faced with uncertainties, we continue to rely on the earnings growth of the companies we invest in to guide the path forward, as whatever happens in the world, we know that the share prices follow earnings in the long run. In our market outlook, we see three common questions. Don't higher interest rates equal lower multiples for earnings growth? The short answer is yes. As rates go up, multiples go down, but importantly, interest rates can only go up so much. There is simply too much debt in the world for long-term interest rates to get much higher than 3%. But won't earnings growth suffer from higher interest rates and input costs? Again, the short answer is yes. Earnings growth will slow in this environment. The Fed is actively trying to slow the economy, and the reopening tailwinds are beginning to slow. However, the structural trends that drive our companies will endure. What if the war escalates? What if China invades Taiwan? Clearly, we don't have a crystal ball, and we don't know what the next big shock around the corner is. This is not necessarily an environment in which to be fully invested. However, we have worked hard over the past several months to improve the overall quality, valuation and diversification of the companies in the fund, as well as screening to ensure we're comfortable with every company's balance sheet. In conclusion, we would encourage investors to take a big step back and look at where we stand today in the landscape. Equity markets have been strong for a long period, but volatility is here and markets could be difficult for a little while. In the end, long-term interest rates are unlikely to move up dramatically. There's simply too much debt in them. We remain excited about the opportunities presenting themselves, and we'll look to use this volatility to position ourselves for the months and years ahead.